Hello, Nitin sir. Hello, Muthu sir. Good morning.
Hi,
Hardik will
hi,
be
good
joining
morning.
in.
Good morning, good
Hardik,
morning. Yeah.
Sure, we'll wait. We'll wait.
yeah.
Do that. Yeah, okay. Thank you.
Okay, perfect. So thanks for taking the time. I actually knew Anup from my Lehman days many years ago. So we had started together. I think he was working with you guys in terms of the whole process, right? I'll give you a quick background of ours, and then maybe we can then get into. We've done enough work on Radiant, so we can get into Q&A if that is okay with you.
Perfect,
Yeah.
perfect.
So we have about, we're a PMS. We have about 200 crore under management, and we look to kind of invest into companies on a bottom-up basis, only like somewhere between 10 to 15 companies, and then average holding period is about 5 years. And try to find kind of sectors where there is some kind of a change or a big runway for growth. So that's the idea. Before this, I was with a FI fund called Voyager, which is based in Mauritius. Um, and I got Dia with me on the line. She's working. She's an analyst at White Whale as well. Yeah. So
Yes,
yeah,
great.
yeah. So I mean, we've been looking into this space overall, for some time, and particularly with Radiant, into this cash management side, wanted to understand from you, basically the addressable market, the growth potential here, and then maybe we can talk a bit about the competitive landscape from again everything from like a more 3 to 5 year perspective. Um,
Sure,
so
sure, Hardik.
Maybe I can start with just you in your DRHP, and you've talked about the total addressable market in terms of retail touch points, and I think by FY'27 you're talking about 40 lakh kind of touch points. But out of that, I think while the percentage is organized is increasing, if it'll still go to about 20%, which is about 8 lakh. And of that, I think two odd lakh is what is the one which is outsourced. So I want to understand from you that, how are you guys looking at kind of maybe increasing this? Is it possible to get, the organized outsourcing percentage higher? And is it even possible to kind of look at the unorganized as well? How are you thinking of this business model or to increase the TAM?
Sure. Okay, sure. Uh, we approach this. See, the what is given in DRHP is by the external agency.
Yeah.
We have our own approach of addressing the target potential markets. Let me just explain. If as in India has 2 crore different forms of retail outlets, from roadside shops and mom and pop stores to fully organized retail, 2 crores. Okay, this number was 1.2 crores about 10, 12 years back. Recent estimates is in the range of 1.8 to 2 crores. That is the total number of different forms of retail outlets. And organized retail has been in the range of 15, moving towards 20% in India. But for us, individual subsegments differ in a sense, behave very differently in terms of adopting to retail cash management.
Okay.
I'll just give you one example. Jewelry. India has 1.3 lakh jewelers registered with BIS for hallmarking. And between them, they have 3 lakh jewelry outlets. In our mind, the entire 3 lakh is a potential target market for us. Even the smallest of retail outlets, single retail outlets, because of the volume of cash handled in those outlets will be very high. Whereas if you split that into organized, then you will say that only Tanishq is organized, Tangamail is organized, and Kalyan Jewellers is organized. but the rest of that are not organized. But that's not how Kunal is your colleague, is it?
Yeah.
So the for us, as in realistically, as in a sense, if we need to target as in anywhere between 30 to 40 lakh outlets could be potential retail outlets that can adopt retail cash money. And today, as in what we are doing is 70,000 outlets. The entire industry is doing less than maybe 1.6 lakh, 1.7 lakh outlets.
Yeah.
Why the such low penetration? So low penetration because all along this is a product that is being offered as a value-added service by banks to its customers. That I will bring the bank to your doorstep. I will offer doorstep banking to you as a value-added service. So they are selecting offering this only to larger clients or those clients where they see a potential for offering host of other services from the bank. So all along till about 3 years back, we were riding on the marketing efforts of the bank. Okay, so bank used to continuously give us feasibility requests. We will revert to the feasibility. Hey, can you hear me?
Yes, yes.
Hello, Nitin?
Yes.
Yes, you are audible, sir.
You can hear me?
I think there is a slight connectivity issues at Muthuraman's house. Sir, you're audible.
Yeah, I'm sorry. I think I went this thing. Just switched my broadband. Hadi, can you hear me?
Yeah, I can hear you.
So till about 3 years back, we were entirely dependent on the bank's own marketing efforts. They keep giving us feasibility requests every day, and we will be responding with the feasibility on that particular location, the particular pin code. And bank will give us a letter of intents, and we will start picking up from those points. Since 3 years back, we have added a new stream, which is to approach customers, retail customers directly. So today, the entire public sector bank, with the sole exception of State Bank of India, do not offer doorstep banking as a service to their customers. So if you are a retail outlet, you are banking with Canara Bank, you have no choice of availing our service.
Yeah.
Even if you have 20 outlets or 200 outlets also, you have no choice of availing our service. So that's a fairly large market, as in our own estimate, assuming that the AUM is a reasonable reflection. All public sector banks, excluding SBI, will account for about 50-55% of the banking sector. And that is a complete blind spot for us, as in because those customers have never availed a service of this nature. So our focus on direct customers is specifically to address those retail outlets which are banking with public sector banks.
Got it.
Okay. And so that is, so if you see small green shoots of that, at the time of DRHP, our direct revenues were 1.8% of our total revenues. Today it is 5.2%.
5.4%.
5.2%.
5.2%. Okay.
In Q4.
And this you're talking about purely from the cash pickup and delivery segment, correct? Or you're talking about
only
that
in the
plus?
cash pickup. Only in cash pickup and delivery.
Okay. Okay. Just, but while I understand the PSU banks ex SBI might not be there, but even if I were to take that out, our penetration within the private banks plus SBI itself is, and the touch point or their customers that would be so low.
Yes. So if I remove 50% of it, my penetration levels are from 3% would go up to 6%.
Yeah, which is again very, very low, right?
Very low. Yeah. So there are different reasons for this. The one, as I see, this service is relatively nascent in India. It's 20 years old, and it is first started by foreign banks. I think first one was Citibank, and then other foreign banks started offering this. Then new private sector banks started adopting this. Then old private sector banks also started adopting this. State Bank of India came somewhere in between, I think 2008 or 9, it started offering this. But State Bank of India, in the sense, they don't have an active marketing team to go and offer this as a service, just like any of their services. So if whoever comes and approaches them, if that particular branch manager is kind enough and aware about these services, he will start offering this. Otherwise, there is no active marketing at the from this SBI side. And then if you see now, even small finance banks have started offering this in a big way. Okay. It's only a matter of time before public sector banks, because of competitive pressures, will start offering.
Okay.
The penetration levels in the within those that are offering is also relatively low, because banks position this as a premium value-added service.
Okay.
They're not pushing this the way they are pushing credit cards. So yes, it will grow. Banks will continue to start offering this to more and more customers. And as the retail sector moves, getting more and more organized, more and more eligible, so to say, eligible customers will be offered these services by banks, which in turn will come to us. One thing is clear. One thing is just one point. One thing is clear: if a bank offers this service, they will outsource it. Otherwise, they don't offer. Banks can never send their own people, staff to go and collect cash.
Yeah, but see, so just counter to that is that while the addressable market, as you put it, with 2 crore, and then you break it down, that then remains theoretical, right? Because if this is a very premium service that the bank is going to offer, I would think that they will only offer it to their very large corporate customers, like an Avenue D-Mart, or like a large modern chain, or a large e-logistics company, or a large jewelry company. So the addressable market might actually be quite small then, for where the bank is willing to pay you to provide that service. At the end, you build the banks, right? You don't build the.
No, we build the banks, and in 90% of the cases, the bank builds the customers also. It's not that it's offered as a freebie. So bank in turn bills, and it is a profit center for banks.
Okay.
Okay.
If it's a profit center for banks, then they have an added incentive to push this, just like they have an added incentive to push credit cards. Correct?
Yeah. So yeah, that's the dichotomy. While they position it as a premium service, our charges are nothing anywhere near premium. To visit a particular outlet for 26 times a month with armed guards, armored vans, and driver and custodian and everything, with 100% insurance and everything, our charges start from as low as 2,000 rupees per month.
Okay.
So for bank to make meaningful revenue out of it, they need to offer to tens and thousands of customers.
Yeah.
Okay. And see, if I charge bank 2,000, probably they will charge their 10 customers a 10% margin, 20% margin, and offer it at 2,500 rupees.
Yeah.
So per point per month, 500 rupees. So 6,000 rupees per month into that many number of points that they have to make to. So it's not a very big positive contributor to the bank. So that is why they position this as a premium value-added service that they offer to the banks, to their customers. So that is exactly what you're trying to break by offering direct customers. So when we go and offer to somebody as a direct customer who has never availed something of the service, and then before this call, if I had asked you, boss, if you own a retail outlet, I come and pick up every day for 26 times in a month, how much you would be willing to pay? As in, I'm sure your number is not as low as 1,800 or 2,000 rupees. It will be much higher.
Got it.
Because it makes eminent sense for the end customer to avail a service of this nature, because it eliminates a lot of risk from his end.
Yeah.
Okay, and time saving for that one resource. The risk is that, as in say, they pay us 2,000 rupees a month, and my daily limit is say 1 lakh per month, 1 lakh every day. Every day they can give up to 1 lakh rupees or 2,000 rupees. So if one day, if they send 1 lakh and that boy who is delivering meets with an accident or runs away or whatever happens, that is equivalent to the fees that you would have paid to me for 4 years.
Yeah. And you cover the liability side.
100%. The moment the cash is handed over to us, it's our risk. It's as good as having deposited in the bank.
Got it. See, the only thing again I'm like grappling with is if I look at even our revenues out here over the last 5 years, it's a CAGR of 11%. Last year, though, obviously, I understand from the call that there were some issues on the e-commerce side and pricing pressure, etc. But for a market that has such low penetration, you would want to see much stronger growth if this is something that the value proposition is strong as what you're proposing.
Sir, just to do me a favor, you can do 10-year, 15-year CAGR, 10-year CAGR from 2013 to 23. It will be 17%, 18% CAGR. Revenue CAGR of 18%, EBITDA CAGR of 26%, PAT CAGR of 31%. Okay, so 24 is an aberration. Multiple reasons for that. One was the petroleum sector. Because of Ukraine, there was a sharp downturn with the domestic, as in the private players routed their refined capacity to export to Europe rather than supplying their domestic outlets. So that resulted in a sharp drop. I told you, as in we had explained in calls multiple times. E-commerce logistics, we did face some challenges and erosion in numbers.
What are the challenges in the e-commerce logistics front, particularly?
Yeah, so e-commerce logistics, what happens is, see, e-commerce logistics players handle a wide variety of products. For 300 rupee lipstick, also they will deliver 5,000 rupee this thing, then jewelry also they will deliver. So the amount of cash is very uncertain at a single outlet at any given point of time. And so for very low volume of points, they have adopted payment banks who have offered instant cash to that, up to a limit, up to 10,000 rupees or up to 20,000 rupees. Somebody will come and collect the cash and give them instant credit for a much higher fee, but the fee in absolute terms will be small. Higher fee in the sense, higher percentage fee. So payment banks
are basically offering the service which is similar to yours then?
No, they cannot handle. See, the payment banks, the very principle is that somebody should be having a wallet balance of that amount to give that instant credit to the merchant. Because we handle 500 crores of cash every day. There are outlets where we will pick up 24 lakhs, 25 lakhs.
E-commerce logistics, particularly when you said the Insta credit with the payment banks. So the payment banks, instead of you going to these small, let's say,
No, this is it's a dark store of a delivery or e-com express or express piece, etc. is where this challenge was, and the challenge has been addressed now. We also are offering up to a particular limit, instant credit. And
how does this work from a payment bank perspective? Their person will go there, and let's say there's
payment bank has banking correspondents or business correspondent.
So they will go.
Local retail outlet will be this thing. So they have an app. They will, just like you call for an Ola, you call for saying that I want to hand over 10,000 rupees cash. So whichever is the nearest merchant BC with the wallet balance of that amount will accept it, come pick up, give credit. And go for
this is like what Fino is doing essentially, right? I mean, that would be a large.
Fino as a payment. Yeah.
Understood. So you offset this
by. But we also launched Radiant Insta Credit. Okay. CMS has launched something called CashX. We have launched something called Insta Credit. So for very small volumes, this cannot work at high volumes because the fees that we incur, the cost that we incur, and the fees that we charge The moment the amount crosses 50,000 rupees, it will be highly uneconomical for the outlet to adopt this.
Hmm. Hmm. So again, if we were to look back a
So,
little bit
but
on,
the flip side of this is that because I'm offering instant credit like this, that entire 2 crore is my target market now. Even the smallest of guys, I can offer this pickup service.
yeah,
There is no
that
bank involved. There is no credit risk that he is taking. None of those, as in he doesn't need to know who I am, as in what is my balance sheet, what is my credibility, nothing.
yeah.
They can get it instantly, but very small volumes.
So that's what I was going to ask then. Like, if this becomes like, if you were successful, I mean, you started down this path of going directly to the customers, and so you're no longer reliant on the banks, and you can start providing solution. How are you guys looking, depending on your feedback from customers and clients, etc.? I mean, how are you guys looking at this from a 3 to 5 year perspective? What percentage of your business would come directly from clients versus from banks? And would this then cause an acceleration growth rate? If so, what is the pace of growth you expect in next 3 to 5 years?
First of all, as in I want to make a distinction between direct clients versus InstaCredit. These are two different things. Yes, InstaCredit will be through two direct clients as well. But for most of the direct clients, we will pick up and deposit cash in their bank account and they will get credit the next day.
Yeah.
That is a lot more economical for them and more profitable for us.
Okay.
Okay, InstaCredit will involve certain costs and a blocking of working capital, all of that. So we will definitely not be able to offer Insta. See, if I have to, technically, I do 500 crores of cash every day. So if I have to offer that to everybody, then I need 500 crores working capital. I don't have that kind of.
Mm-hmm.
Okay, and that is not the instant also because the cost and the bank charges will be very heavy for anyone to even sustain that. So this InstaCredit is restricted to very small outlets with daily volumes in the range of 5,000, 10,000 rupees. And the charges per thousand are very high compared to our regular business. And we don't expect it to grow to very large amount. Maybe in 3 years, 4 years time, it could be 5-6% of my revenues. But my direct clients, I'm expecting that the direct clients, it's already 5.2%. That will go up probably to 15% in 3-4 years time.
In 3-4 years time to 15%.
Yeah, that could be the target that we
got it.
But even then, bulk of our business is bank.
Bank.
Today, 95% is 5 years, 3 years down the line, it will be 85%. But still.
Okay. Any particular industry who's more open to doing the direct kind of model?
We're getting a good response across industries, as in including organized retail. So there, it's not the industry; it is who they are banking with. If they are banking with Canara Bank, Andhra Bank, Dena Bank, Punjab National Bank, they are happy to do it directly with us because their bank doesn't offer this as a service.
Understood. And in terms of the pricing model with the banks, I think on the call you were mentioning about moving from a fixed price towards a volume driven model. So how is the acceptance been? What percentage is on volume driven? And
It's a
how
very
does the
select.
just out of that, how does this work from an operating leverage perspective?
It's not on very high as in essence, not every client, not every bank, we are witnessing this. Few select high value clients have moved that model with an assurance that over a longer period of time, what they give to as in essence, as the volume picks up, we will be able to make up for the immediate drop in revenue. So few select clients, in my mind, as in essence, probably a single digit, less than 10% of our revenues on the pickup. See, our burial revenue is entirely, our network cash management revenue is entirely volumetric. It is always priced as price per thousand or price per lakh. The cash pickup and delivery used to be a fixed charge. Maybe about less than 10% of the points have moved to variable charge.
Okay. So largely it remains fixed price.
last year.
And in terms of customer concentration from a bank perspective, I mean, like, what would be the largest client? What would be the top 5?
Yeah, we discuss that every quarter. I'll just tell you. Topmost client will be 15%. Just give me a second. I'm just giving that. Our top client is 17%.
Okay.
Top 5 is 58%.
Got
And
it.
top 10 is about 80%.
Top 10 is 80%. Okay, got it.
This is from a bank perspective. These are
Yes.
bank perspective. We
Yes.
disclose this thing also separately in terms of end customers also in our KPI.
Yeah, I saw that. I think BFSI is the largest, right? And then it's
Yeah.
okay. And this is essentially, I mean, there are multiple players, but essentially it's a two-player market, right? In the sense that you and
Essentially.
CMS Infosystem are the largest.
Yes, that's right.
Both of you are approximately the same size.
In the retail cash management business, we are slightly bigger than.
Slightly bigger. Yeah. So just to understand out here, I mean, like, do clients work with both of you, or it'll be with either one of you?
There are few clients who are exclusively working with us. I'm sure there are a few clients who are exclusively working with competitor also. But by and large, banks will be having empanelment of 2, 3, 4 players. Okay. But whoever has the highest network density will get maximum share of wallet share.
So
is there
any region where, like, you were bigger, and then in other region where CMS is bigger, or it's
not by region, it's by banks. Some banks, as in the sense, we have a much higher wallet share. So in some banks, we are plan B for them.
Okay. In your call, you mentioned there was pricing pressure in FY'24. So is that being driven by CMS, which is kind of putting pressure on you? And, or how are the competitive dynamics between you and them and the other smaller players?
The banks and the market is seeing the numbers of the players for the first time. So both of us got listed in the last 2 years.
Yes.
So then obviously, the question arises for the banks, that was if this is the kind of margin that you are making, why are you asking for a price increase? Why can't you offer some discount, bulk discount for high value customers? Our target contract pricing has remained the same, and almost 80% of our revenues will go through the target, the agreed contract pricing. Deal level pricings, there will be some small negotiations do happen, and we do have witnessed some pricing pressure on those deal level, few high value end customers, etc.
And end customers, you're talking from the bank perspective, who are coming back and asking for price reduction. So then, is it fair to say that, like, because see, one of the attractive things about this industry is that, as you grow and the touch points increase along a certain route, there is operating leverage, correct? And that's why you said, like, if you look at the last 10 years, 17% top line, but 25%, let's say, EBITDA, right? There's an inherent operating leverage. But now, if the banks can come back and cut off this operating leverage and keep on asking for volume-related discounts, then shouldn't margins be kind of flat?
No. Okay. So the 2, 3 things. One is that our actual absolute pricing for each point is bare minimum. As in, if a bank has to do it on their own or through anybody else, the price that I charge won't even cover the fuel cost for them. To visit an outlet 26 times a month and charge them 2,000 rupees, it is like 70 rupees per visit. That will be the fuel cost, right? So the absolute bare minimum pricing at individual points level. So for very large customers, there could be, as in a sense, when they aggregate the total payout that they make to the bank or to us, there will always be a temptation to negotiate that price. But one thing is, as in the sense, all our costs are going up. Employee cost goes up every year. Fuel costs increase occasionally. Van costs increase, etc. The driver, gunman costs, etc. But we don't increase our prices. As in the sense, there is no built-in price escalation in any of our contracts. So banks understand that. So we
Yeah,
are
but
making this kind of EBIT margins because we are able to leverage across multiple banks
yeah. No, I
and
understand.
direct customers.
But what
And
I'm
direct
trying to
customers.
get to is that, like if I look at FY'24 over FY'23 also, we still grew by like 10% odd, right? And in spite of the top line 10%, our margins fell from like 30% to let's say 16%. I know there were these issues on the petroleum side, there were issues on the e-commerce logistics front.
No,
But
no, but
this margin
more
pressure
than
actually have come
half of
from
that
pricing.
more than half of that margin drop is because of our entry into valuable logistics segment, which is a investment. As in, we
Got it.
just got into that this thing.
Uh-huh.
Substantial, more than half of that.
Okay. So if it fell
Okay.
by about, let's say it fell by about 13 to 14%, you're saying 700
No,
basis
I
points?
think it fell by about 12-13%.
Yeah, 12. So 600 to
Okay,
600 to 700 basis
12-13%.
points is
Half
because of
of it,
inflation.
a little more than, actually half of it is because of that.
Understood. Understood.
And see, at 10%, see, the operating leverage cuts both ways.
Yeah.
If I grow at 18%, my costs grow at 10%, my EBITDA margins will grow at a higher rate. But if I grow at 9% and costs grow at 11%, we'll cut down the EBITDA margins, right?
Yeah.
So top line growth is essential for maintaining that operating leverage, and all our focus is on.
Got it. How, I mean, so what is the kind of growth rate, let's say 3 to 5 year CAGR, what would it be similar to
18-20% is our
18 to 20%? And do you see this business becoming a duopoly? How is CMS as a competitor?
It is a duopoly largely. So there's a third player, a distant third player, Writer Safeguard. But beyond that, there are hardly any other player. And as I said, competition intensity is not very high. As in the market opportunities are so huge. So that's where, in a sense, we are approaching more and more customers who have not even heard of this service, who are surprised that a service of this nature can be afforded at this such low price, and onboard them in remote locations. We have the widest network and coverage. Incrementally, 65-70% of our business comes from tier 3 plus locations. So those are the target markets. As in there is no competition. As in ignorance is our biggest competition.
Yeah, but just to understand, I mean, like right now, still 95% of the business is banks, correct? So a lot of it is bank driven, where the banks will tell you, okay, get on board this customer. So what I'm trying to get to is, do you find yourself, where the bank will be like, listen, we have this customer XYZ, what will you charge me? And then they will compare that to what CMS is going to charge. And so then to that extent, it's a direct.
It's like any other competing business. There is no monopoly. It's like any other competing business. All we appeal is to the common sense, saying that, boss, otherwise, as in at 2,000 rupees, how much low I can go?
Yeah. No, what I'm trying to tell you is, see, like your client concentration, top 10, right? I mean, given the banks right now form a large chunk of your revenues, clearly client concentration is high, which
No,
would be
no.
like.
And with each of those clients, we have signed long-term contracts, and we got a price escalation, also a 10% price escalation in each of those contracts, 22.
Got
Okay,
it.
so
Yeah. What I'm trying to get to is that CMS will also be their clients. So both of you will be provide, as you said, in every area there are 2, 3, or 4 players that are there who are providing it. And so while this is a duopoly almost, but given the client concentration, which are the large banks, do you get is it where you and CMS got to undercut each other constantly?
It's not, as in what it for banks, what is more important is the quality of service, the risk management, the number of times incidences happen, because we are handling very large volume of public cash. 1.7 lakh crores we handled last year. Okay. So the quality of risk management, the quality of MAS that we are able to provide. For many of the end customers, we have developed our IT system to plug in directly with the core banking solution of banks. So banks can live track this thing. End of the day, they get MIS's data for amenable for data analytics at each point, each outlet, each region. End customers, we have developed plugins for end customers like Amazon, delivery, etc. So for them, it as in a sense, tightly managing the float becomes an important issue for them. What banks will ask us is more and more value-added services, as in, can we give them same-day credit? Can we, as in a sense, offer cash delivery? Can we do holiday pickups? Can we do pickups twice in a day? Those are the issues on which we discuss. I think it's very rarely that pricing 2,000 rupees, you reduce it to 1,900 rupees. That is not going to make the bank richer. That's not going to hurt us too much. And that number is not very significant for them to go and negotiate.
Understood. And when you're winning new banks as customers, how does the process work? Is it on a RFQ basis, or is it like where you go and approach them and you
No. It takes 4 months. 4 months for a new bank to onboard us, because they do complete due diligence, IT audit, and empanelment takes a lot of time, because banks are offering this service to their end customers, basing their trust entirely on us. Right? The end customer, as long as I go there as a representative of the bank, if the end customer doesn't get his credit back the same day or the next day, he is going to hold the bank responsible. So bank doesn't want to take such a big responsibility without knowing whom they are dealing with, what is the customer. It's not like any other vendor. It's a lot more at stake than the fees that they pay us. 100 times actually.
No, that I understand. But what I'm trying to say is, like, when a bank decides to onboard, like let's say there's a PSU bank who's not doing it, or a private bank that's just starting this as a service. They will ask for RFQs from you and CMS, and then like decide on who to go with. Is that how the process works, or it's more of a push product where you go and explain to them the proposition?
No, we go and explain, and we do go through a fairly long empanelment process. Okay. Pricing is a very small aspect in that. I'll tell you broadly, our pricing across banks and for a bank, pricing across service providers are more or less the same.
Okay.
That's not the decider. As I told you, Adin, for few specific and high value end customers, there could be some talk about discount. But otherwise, our pricing across banks are fairly common. And for a bank, pricing across service providers is also fairly same.
Got it. Just maybe touching on this, the jewelry business that we're entering new, because I think we've done a decent amount of investments in that area. Just maybe I just want to understand, how are you looking at the business? What is so exciting about this opportunity, and how are you looking to scale this up?
So that business actually is the mirror image of the retail cash management business. There are only 2 players. The extent of penetration of organized players is very low. There's a large 60-70% of that business is still
unorganized. 2 players, including yourself?
No, there is a company called Sequel Logistics.
Okay.
And there is a company called BVC Logistics.
Okay.
These are the 2 players.
Okay.
As I said, 1.35 lakh jewelers, 3 lakh jewelry outlets, but between BVC and Sequel, probably they are catering to 10,000 names or less than that. So penetration levels are low. A good unorganized sector like Angadiyas, etc., or people just carry it in their person and deliver.
Yeah.
fraught with risks. So again, a service of this nature with low per unit pricing, but a high, in the sense, high operating leverage is how we are approaching that. And very similar nature of business, handling high value cargo. And so the risk management, integrity of the people who are handling this business, all of that becomes important. One thing that distinguishes Radiant in cash, even in retail cash management, is that we are the only ones which is headed and run by largely by ex-servicemen.
By who?
Ex-servicemen.
Okay.
Okay. Chairman is Colonel David, 25 years Army veteran. COO is Colonel Benz, again 25 plus years in Army. So across the hierarchy, we do have 22% of our total staff strength is from ex-service. Probably another 20% will be kith and kin of ex-servicemen. Okay, so the moment you call, it says, so it is run like a quasi-military operations, handling such high volumes of cash, reconciling rupee to rupee every day. Is a very intense, in a sense, operationally intensive business. Regulatory requirement is a minimum net worth of 100 crores. Anybody can put up 100 crores. But to replicate this kind of operational intensity with integrity, see, we handle 500 crores of cash every day, and our net worth is what, 230 crores. If one day, if all of them vanish, our net worth will get wiped out. So it has to be managed in an extremely tight manner, and our cash losses are far superior than the rest of the industry.
Okay. What is our like cash loss or risk loss that we?
In a year, total gross incidences are roughly in the range of 3 to 4 crores of rupees. The actual P&L impact is anywhere between 1 to 2 crores. This is our financial.
On a revenue of, let's say, 300 odd crores.
On a volume of 1.7 lakh crores that we handle.
Got it. So this on the jewelry side, I mean, can we use the same route, or this will be a completely different route and different? You cannot mix it with our cash management business, right? And the route.
Some of the infrastructure we do use commonly. Vans, cars, drivers, in some places, common locations, etc. We use it commonly. But otherwise, it has to be built from the scratch like this. And maybe as in this year, hopefully, we are hoping to break even.
Got it. And this out here, in terms of size of this market, because there are two players. I know that the addressable market is huge out here.
Sequel is as big as Radiant, consolidated, and as profitable as Radiant.
But how big is their jewelry business, Sequel Logistics?
That will be the largest segment.
Largest, like which will be what, like us, it would be.
My sense is 60-70% of their business is jewelry.
So as like what is cash management for you is what it is for them.
Not as in for us, cash management is like 90% of our business. For them, 60% jewelry. 60%.
Got it. And now, I mean, I think even CMS is also looking to enter into this space. So now there will be essentially two large players trying to enter into this place as well. So how?
No, because the 60-70% of the business is unorganized today. So more and more, it will get organized, and it will be as in what is being today. Let us say that in retail cash management, our penetration is 3%. So what happens to balance 97%? They all send their boy to go and deposit cash in the nearest bank branch by carrying it without any armed guard security, etc. Right?
Yeah.
So that's what is happening in this industry as well. People carry large volume of jewelry in a body, in a briefcase, and then travel without any risk, risk prevention measures, etc. So when an organized player with strong net worth and strong risk management practices is able to offer it at an affordable price, adoption is likely to be quite fast.
Yeah, but I mean, just a counter to that is there are two large players, just like how in the cash management side, retail cash management side, there are two large players. As you said, there is a duopoly. Out here, there are already two existing large players who also are looking to obviously increase the penetration rate. Now it's going to become from a two-player to two other large players, you and CMS Infosystem entering this business. Uh, you know, will the rate of adoption increase? I mean, I don't know if that will actually happen. I would think that more players enter, more pressure on margins, no?
See, that business also is a high operating leverage business. Okay, because you incur fair degree of high degree of fixed costs in terms of branch manager, night custodian, and van guard driver, etc. But then a van can carry 100 grams, it can carry 15 kilos. So how much you load decides your profitability. So we are approaching in a methodic manner where individual routes where we can get maximum volumes and turn profitable quickly. So our focus is more on protecting bottom line and achieving profitability quickly rather than scaling up volumes. So
Yeah. Okay.
our sense is that the market is underpenetrated, and with having being a listed player with a reputation in that industry, we believe, and incidentally, out of the 70,000 points that we cater in retail cash management, I think we cater about 3,000 jewelers also, jewelry points also, as it is for cash pickup. So those are ready points where we can offer jewelry pickup as well.
Using the same route.
Not the same infrastructure.
Not
See,
the same.
the time of the day differs for between these two. The cash pickup and deposit happens usually between 10 a.m. to 2 p.m. Most banks don't accept depositing of cash beyond 2 p.m.
Okay.
And while I pick up from 3,000 jewelry outlets, in that route I'll be picking up from a jewelry outlet next door, consumer retail, consumer electronics. The third could be an NBFC. A fourth could be an insurance branch. I'll pick up from all of these and go to the nearest bank and then deposit. Whereas this is focused only on jewelry, as in from airport to a particular branch, sorting and delivering to different jewelry outlets in that particular city. So yes, we do use some common infrastructure because here the delivery can happen in the evening and the night as well, or very early morning as well when we get the consignment from the airports.
Got it.
Some common infrastructure, but not the same routes.
Yeah, understood. Since you said you're looking at, doing this more gradually and kind of focusing on getting to profitability quickly, how big do you think this would become? Like, let's say 5 years out, what percentage of your revenue are you targeting to get from the jewelry side?
In 4-5 years' time, jewelry could account for 20% of it.
20%. Okay. So then it would be like a decently large vertical, which is there. Got it. I guess the only question that again comes back to me just on this is, just how you and CMS Infosystem have barriers to entry on the cash pickup side. Don't you think BVC and SQL have equal barriers to entry on the jewelry side?
Okay, so there is not so much barrier. Yes, there is definitely a barrier because they have been around for 20-30 years and the brand recall and all of that is there. But our barrier is more in retail cash management. The barrier is more in terms of the operational intensity. Picking up cash from 70,000 outlets in 5,000 locations. We don't have 5,000 branches. These are all free agents who operate in those respective locations. We have 18 branches. So operational intensity, risk management, etc., becomes very different in retail cash management. Whereas in jewelry, I can fix the routes that I offer. The standard set of routes in which I can be most competitive and still make decent margins. So everybody depends on the same airlines. Everybody depends on, other in the sense, the same same insurer. So, and a good part of that volume comes in exhibitions. During exhibitions, large amount of shipment to the exhibition venue and back to spectators, etc., gives big volumes. Okay, in a year, some 10 12 exhibitions happen. So we think we have a fair chance to this thing, and our credibility in terms of operating complex operations and complete risk management in our table works in our favor to have a right to win in this.
Got it. Besides exhibitions, also, I'm guessing
Hardik, I have a hard stop at 11.
Yeah. Just a couple of
Hmm.
questions from my end. One
Sorry.
is that
Yeah.
besides on the jewelry, I mean, jewelry besides the exhibition, I'm guessing jewelry is also very concentrated. Like, for example, the diamond bourse or like Jhaveri Bazaar, so that it's more dense
The
in terms of.
production side is very concentrated. The consumption side is very distributed, very wide distribution. Even the smallest of a town will have a jewelry outlet, right? You go to a tier 4 town, that will have 3-4 jewelry outlets, and that jewelry has to reach there in a safe manner. So the production distribution at this side, as in import happens in Bombay. Most of the production happens in Surat, Ahmedabad, the Bombay regions. So the origin many times is from West, but the delivery could be a Senco in Calcutta, could be a Kazana jewelry in Chennai, could be whatever these Malappuram and this Muthoot, those kind of people in Kerala, huge, large jewelry outlets in Kerala. It could be in Delhi, it could be in Karnataka, everywhere.
Understood. And just one last question from me is on this, besides cash pickup and delivery, you provide network currency management, you do the cash processing. How much of a premium do you get on pricing? Like as you mentioned on 2,000 rupees a month we're charging. If you were to managing this, then what is the value add pricing that you can charge?
I'll give you a good simile. And then Indigo makes more money in their selling sandwiches than actually flying the aircraft.
Yeah.
All right. So that is the simile here. Okay. Cash processing. We charge cash processing some small amount per 1,000. But then the same guy who picks up the cash does the processing. So there's no incremental cost to that. In network cash management, yes, we do charge extra premium and we do incur some bank charges, but the contribution margins are fairly healthy.
Yeah. So is
Only
there
these two? The cash van operations is an independent, different segment. The gross margins are comparable or slightly lower than our retail cash pickup, retail cash management business.
Got it. So, I mean, combined, actually, this network currency management has been falling as a percentage of revenue, but I guess that's also because there is, more and more availability of local branches of the banks for your customers, right?
No, it's not. It's not because of that. See, bank branches have not gone up so dramatically in the last 2 years for this purpose. It's to do with the mix of our clients. Okay. So if I do more foreign banks, I will have a higher share of retail network cash management because their branches are far and few. If I do more domestic private sector banks, as in I don't make any network cash management revenue from, for instance, State Bank of India. They don't offer as a service. They don't offer pickup service where they don't have a branch.
Understood.
So it's a question of mix of customers and who is growing faster within our customer base. It's not to do with the certain increase in penetration of bank branches.
Okay. Got it. But on the cash processing side is something which is growing very strongly. So you'll want to continue to increase as a percentage of your offering to the bank.
No. So for every point we offer cash processing as a value-added service. It's up to the customer to adopt it or not.
Got it. Okay. Yeah, those are all the questions. Dia, Kunal, anything from your end before 11 o'clock?
No, nothing
I
from
just I just wanted to understand. So outside of this, the jewelry side of the business, are there any other kind of value add or managed service type initiatives over and above what you guys doing on the cash side?
No, we don't intend to get into ATM segment or managed service provider segment at all. These will be our three key growth drivers. The direct customers, valuable logistics, that is the jewelry, and cash van segment, dedicated cash van segment.
And why
So
not? I mean,
these three,
I'm assuming you guys must have evaluated the others as well, right? In terms
see,
of what else you all can do.
yeah, see, for you to be an MSP, you need to be offering ATM service. And we believe ATM servicing does not have enough money. Okay, that is the profitability is low. It's fraught with lot higher risks. You see the kind of bad debts and credit losses that competitors report, and it's in the range of 100 crores. Ours is 1 crore.
Hmm.
So, in a sense, we had, as I told, we had entered into ATM segment long back, 2016, and quickly realized that that business, in a sense, at scale, probably it will achieve margins. For a new player, there is no scope for that. It will be a drain for a long period of time.
Are there any other services that you can offer just in terms of value add services to the same customers that you guys are already kind of catering to?
No.
In
So
terms of an extent?
our focus at this point of time is offering this service to more and more end customers. And because I said, we firmly believe that our service is extremely underpenetrated. For a retail outlet, it makes eminent economic sense for them to adopt a service of this nature at such low prices. And huge growth opportunities exist in this business itself, and anything else is a distraction.
Okay, fair enough.
Okay, great.
Right.
Thank you so much for taking the time to talk to us. It was very
Sure, Hardik. Yeah.
Thanks so
you.
much.
Yeah.
Thank you.
Thanks, Nitin, for arranging.
you.
Thanks,
Thank
Dia.
you.
Thanks, Kunal. Bye, Hardik. See you.
Bye bye.
Bye.